Last spring, Zane sat across from a mortgage officer at a credit union and asked a question that had been bothering him for 3 weeks. He had been tracking rates obsessively, watching them shift almost daily, and he wanted to understand why. Not the surface answer, the real answer. The loan officer smiled, the kind of smile that means, "I am about to give you a non-answer," and said the rate reflected current market conditions. Zane nodded, signed the paperwork, and drove home with a 30-year obligation at a rate he did not fully understand and a feeling that something important had just happened without his complete comprehension. That evening, he started reading. He read for 3 months. And what he found was that the number on his mortgage document had nothing to do with his bank, nothing to do with his credit score in the way he assumed, and everything to do with a market he had never once thought about. A market larger than every stock exchange on Earth combined. A market that quietly sets the price of nearly every financial decision a person makes across their entire adult life. That market is the bond market. And by the end of this, you will understand it better than most people who work in finance ever bother to explain. Start with the simplest possible thing. A bond is a loan that gets traded. That is the entire concept. When a government needs money it does not have, or a corporation wants to expand without diluting its shareholders, they borrow from investors directly. You hand over a fixed amount, call it $1,000. In exchange, they promise 2 things: a regular interest payment every year, called the coupon, for the life of the loan, and the return of your original $1,000 on a specific future date, called the maturity date. The U.S. government does this constantly through what it calls treasury securities. Large corporations do it through corporate bonds. Cities do it through municipal bonds. Companies with shaky finances do it through what the industry calls high-yield bonds, which used to be called junk bonds until someone in marketing decided that name was bad for sales. None of this sounds complicated yet. It isn't. The part that breaks people's intuition, the part that caused some of the largest financial disasters of the past 20 years, is what happens to bond prices when interest rates change. The single most important rule in fixed income. Zane had owned a bond fund inside his retirement account for 4 years before he understood what he actually owned. Here is the concept that would have changed that. Imagine you buy a bond for $1,000 that pays 2% annually, $20 a year. Fine. A year later, rates rise across the economy, and brand new bonds with the same $1,000 price now pay 5%, $50 a year. Now, ask yourself a simple question. If you wanted to sell your original bond, the one paying $20 a year, who would buy it? Nobody would pay $1,000 for $20 in annual income when they can walk across the street and get $50 for the same price. The only way your bond becomes attractive is if you lower the price until that fixed $20 payment represents roughly 5% of whatever someone pays for it. That math works out to a price somewhere around $400. You paid $1,000. You're selling for $400. You just lost $600 on a safe investment. Not because the borrower defaulted, not because anything went wrong with the bond itself, simply because interest rates rose. This is the rule that everything else in this script builds on. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. They move in opposite directions always, without exception, with mathematical precision. Tattoo it somewhere useful. There is a single interest rate that most Americans have never deliberately looked at, which quietly determines the cost of their mortgage, their car loan, their landlord's financing, and their employer's ability to fund operations. It is the yield on the 10-year United States Treasury bond. Right now, it sits in the range of 4.5%. Here is why that number reaches into your life even if you have never purchased a bond. When a bank considers lending you money for 30 years to buy a house, it faces a choice. It can lend to the United States government for 10 years at the Treasury yield, essentially zero risk of non-payment, or it can lend to you. You might lose your job. You might have unexpected expenses. You represent risk that the U.S. government does not. So the bank takes the Treasury yield and adds roughly 2 percentage points to compensate for that additional risk. That addition is your mortgage rate. When the 10-year Treasury was sitting near 1% in early 2021, mortgage rates dropped to historic lows and stayed there for months. People borrowed in volumes the market had not seen in years. Housing prices jumped dramatically in a single year, far beyond any historical average, because money was extraordinarily cheap. Then, the 10-year yield climbed sharply as the Federal Reserve raised rates to fight inflation. Mortgage rates crossed 7% and then touched 8% by late 2023. The housing market did not crash, it froze. Sellers who had locked in 2.5% mortgages refused to sell because buying anything new meant financing at 3 times the rate. Buyers who could have qualified at 2.5% couldn't afford the same homes at 7%. Volume collapsed. The bond market did that. Not the Fed alone, not the banks, not the economy in some vague general sense. The bond market repriced the cost of money, and the housing market reorganized itself around the new price. When safe stopped being safe. Zain had always kept what his retirement account described as a conservative allocation: 60% stocks, 40% bonds. The standard advice: stocks for growth, bonds for stability. His bonds were his seatbelt. In 2022, the seatbelt failed. The Federal Reserve raised interest rates from near 0 to over 4% in approximately 9 months, one of the fastest rate increases in modern history. Apply the rule. Rates rise sharply, existing bond prices fall sharply. The broadest measure of the U.S. bond market fell 13% that year, the worst calendar year performance in the history of that index. Long-term government bonds, the assets most people consider the safest in existence, lost nearly 40% of their value in 12 months. Zain opened his statement in January of 2023 and stared at the number for several minutes. The part of his portfolio designed to protect him had lost more than some of his stock holdings. He had not been lied to exactly, but he had not been told the complete truth either. Bonds protect against one specific risk: the borrower failing to pay you back. The U.S. government will always pay you back. What bonds do not protect against is the risk of rising interest rates making your fixed payments worth less than what new investors can get for the same price.
That risk has a name: interest rate risk. And it is the risk that almost nobody explained to him when he selected his conservative allocation. There is a measurement called duration that tells you precisely how exposed your bonds are to interest rate changes. It sounds technical. It is actually straightforward. Duration tells you approximately how many percent your bond or bond fund will decline for every 1 percentage point rise in interest rates. A bond fund with a duration of 5 will lose roughly 5% of its value when rates rise 1 point. A long-term Treasury fund with a duration of 17 will lose approximately 17% per point. In 2022, rates rose more than 4 percentage points. If you held a long-duration bond fund through that period, the math is uncomfortable to calculate. Every bond fund publishes its duration on its fact sheet. It is listed clearly and updated regularly. Most investors who owned bond funds in 2022 had never looked at that number. They owned duration they did not know they had and experienced losses they did not know were possible in assets they believed were safe. Duration is the honest risk label that nobody reads. Zain reads it now. 3 things that happened when people ignored this. The rule, rates up, prices down, is simple enough to state in a sentence, but watching it operate at scale produces consequences that feel genuinely hard to believe until you see the sequence clearly. The first example is Silicon Valley Bank in March of 2023. SVB received enormous deposit inflows during the technology boom of 2020 and 2021. It needed to do something with those deposits. It bought long-term government bonds, the safest assets available, in very large quantities. Then rates rose. Apply the rule. The bonds SVB held fell significantly in market value. The bank had not lost money on bad loans or speculative investments. It had bought the most conservative assets imaginable at the worst possible moment in the rate cycle. When it needed to sell some of those bonds to meet deposit withdrawals, it crystallized billions in losses. Depositors found out. Withdrawals accelerated. The bank went from operating normally to seized by regulators in approximately 48 hours. The second example happened in the United Kingdom in September of 2022. A newly appointed prime minister announced a large package of unfunded tax reductions. The bond market looked at the arithmetic: more government spending, no offsetting revenue, existing deficit already elevated, and responded immediately. Investors sold UK government bonds in volume. Yields spiked sharply in days. That spike triggered forced selling inside British pension funds that had used complex leverage strategies tied to bond prices. The selling pushed yields higher. Higher yields triggered more forced selling. The Bank of England intervened with emergency purchases to prevent a collapse of the pension system. The Prime Minister resigned after 45 days in office. A sitting leader of a major economy was effectively removed from her position by the arithmetic of the bond market, responding to a fiscal announcement it found unconvincing. The third example is quieter, but in some ways more instructive. In 2020, Austria issued a government bond with a 100-year maturity paying less than 1% annually. Investors bought it enthusiastically because at the time, roughly $18 trillion worth of bonds globally were yielding negative returns. Investors were literally paying governments for the privilege of lending to them. Austria's sub-1% yield looked attractive by comparison. Then rates normalized. That 100-year bond lost approximately 3/4 of its peak value. The Austrian government will pay every cent it owes. The bond is as safe as any investment on Earth in terms of default risk, but anyone who bought it near the peak and needed to sell it before the year 2120 experienced losses that looked nothing like safety. One rule: a bank, a government, a pension system, a sovereign bond. The same mechanism operating at different scales. What this means for the largest borrower on Earth. The United States government currently carries approximately $39 trillion in total debt. That number is large enough to be essentially abstract. Here is the number that is not abstract. This year, the federal government will spend more than $1 trillion on interest payments alone, not reducing the debt, not building infrastructure or funding programs, just the interest. The annual interest bill now exceeds the entire defense budget. It is the second largest line item in federal spending, behind only Social Security. Foreign investors who once held more than half of all outstanding U.S. Treasury securities now hold closer to 30%. The customer base for American debt is shrinking at exactly the moment the supply of that debt is growing. When demand softens and supply grows, the price adjusts. In bonds, price adjusting downward means yields adjusting upward. Higher yields on Treasury securities means higher rates on mortgages, car loans, corporate debt, and every other instrument priced off the benchmark. The government's borrowing cost and your borrowing cost are connected through the same mechanism. What happens to federal finances eventually arrives at your mortgage statement. Zane understood this clearly after his 3 months of reading. The number on his mortgage document was not arbitrary. It was the output of a system that ran from federal fiscal decisions, through the Treasury market, through the 10-year yield, through his bank's pricing model, to the figure on his closing documents. He couldn't control any of those inputs, but understanding the chain meant he could stop being surprised by the output. What Zane actually does differently now. Understanding the bond market did not make Zane wealthy overnight. It did make him significantly more deliberate about several things. He moved the cash sitting in his regular savings account into a higher-yielding alternative, a Treasury money market fund, paying several times the rate his bank was offering on the same balance. The bank had been counting on his inertia. He stopped being inert. He looked at the duration figure on every fixed income fund he owned inside his retirement accounts. He found that one of his bond funds carried substantially more interest rate risk than he had assumed when he selected it. He adjusted his allocation with that actual risk in mind, rather than the label on the fund's name. He began checking the 10-year Treasury yield the way he checks weather before making plans. not obsessively, but as a regular input to his understanding of where the economy is going and what borrowing is likely to cost in the near future. When the 10-year yield moves significantly in either direction, Zane now has a framework for understanding what that movement means for his mortgage, his investments, and the broader economy around him. He's not a bond trader. He doesn't need to be. He's simply someone who now understands the rulebook that was always operating in the background of his financial life.
The rulebook you were never given. Here is what Zane eventually concluded from his 3 months of reading. The bond market has been pricing his life since the day he took out his first loan. Every interest rate he has ever paid, every return his conservative investments have ever generated, every fluctuation in his retirement account's bond sleeve, all of it was being driven by a market he had never deliberately examined. He was always a participant. He just never had the framework to read what was happening. The framework is not complicated. When rates rise, existing bond prices fall, and new borrowing gets more expensive for everyone simultaneously. When rates fall, existing bonds become more valuable and borrowing costs ease. The 10-year Treasury yield is the benchmark from which most consumer and corporate borrowing rates are calculated. Duration measures how sensitive your bonds are to rate changes, and the fiscal situation of the largest borrower on Earth has a direct connection to the rate you pay when you finance a car or a house. None of this requires a finance degree. None of it requires trading bonds or following markets professionally. It requires understanding one relationship: rates and prices moving in opposite directions, and applying that understanding to the numbers that show up in your actual life. Zane now does this automatically. It takes less mental energy than he expected and produces more clarity than almost anything else he has learned about money. The bond market is going to keep pricing your life, regardless of whether you understand it. The only variable is whether you can read what it is telling you. If this gave you a new lens for looking at the financial decisions in your own life, hit the like button and subscribe to Wetrix Invest, because next time we are going even deeper into the mechanics of how money really works. And that is a conversation worth having.